So which financial institutions were able to survive this environment? And we know some of the well-known names that did. GE Capital is one, Goldman Sachs is another, JP Morgan Chase is another. And each of these companies had a well-developed corporate culture, a more conservative attitude. Goldman calls its culture conservative, aggressive. They're all very well aware that they don't want to ruin their own company by pursuing highly risky strategies. They care about their own company, their own shareholders. They themselves are shareholders, and often the case, and they care about the company and making sure it doesn't take on excessive risk. How do they do this? It's not easy. It's constantly changing. The profit pool in any industry is constantly changing. And in financial industry, it changes very quickly. So one of the important things in running a financial institution and looking at a financial institution is where are the profits coming from? What is the profit pool? If you can understand the profit pool and whether it's real or not real, you'll understand the company. In the case of the home mortgages, in the case of AIG, the profit pools weren't real. These pools were accounting profits, but not real long-term profits. In the case of a company like JP Morgan, where they had a large branch network and were more conservative in the lending, the profits were real profits. So you always want to be questioning the profit pool. And it leads to a question of what were the directors at Washington Mutual or at Citibank doing? What was the board doing? What were the auditors doing? What was the Office of Controller of the Currency doing? Why wasn't anyone looking at these billions of dollars of assets and questioning whether they're real or not? We're generating huge profits, huge growth, and yet economic theory tells us, we know, that generating profits in the financial industry is difficult, it's tricky. So anyone who's a director of those institutions or examining those institutions has to be very, very skeptical of any reported earnings. And it's very disappointing that all of these safety nets, whether they be the Office of the Controller of the Currency, the boards of directors, the accountants, whoever it was not looking underneath the covers and saying, wait a minute, why are we having such big profits? Normally, economic theory tells us that this is a commodity business, money can be gotten from anywhere, and so why are we generating profits when other people are not? There's two questions here. One is, what is the corporate strategy? And two, what are the safety nets? What are the checks and balances in the company? Are they really being effective? And clearly, despite laws to the contrary, including Sarbanes-Oxley, which makes it a criminal offense to misrepresent numbers on a balance sheet. Despite all of these protections that were put in these cases, no one really questioned, and people did not really question the earnings and balance sheets of these companies until it was too late. Now, what might the government do about that? President-elect Obama has talked about recently proposing one systematic risk regulator in the United States so that companies can't shop from regulator to regulator. And hopefully that regulator, which I think will in some form be enacted, will have a balance of both providing us with stability, but also not forgetting about innovation and growth. One of the things that makes our economy better and lower unemployment than many European economies is that our Federal Reserve, which is a terrific institution, is responsible for both low inflation and maintaining low unemployment. So there's a balance there. European central banks are pretty much exclusively charged with maintaining a stable currency. So they don't care as much about pumping stimulus in to lower unemployment. The same would be true of a financial regulator. The regulator should be careful to look and make sure we have stability, but also to, when appropriate, and this is most of the time, to allow for growth and innovation. Let's take a little more look at a few of the items that have come up in the last few months and take a little more understanding of them. One of them here is the so-called TARP. This is the Troubled Asset Relief Program. This is a program that Secretary Henry Paulson persuaded the Congress to put $350 billion into about 52 banks and other financial institutions. And most recently, the auto companies are getting some of that money. Under the TARP, it was originally to buy mortgage-backed assets, stabilize that market, but Paulson decided after the appropriation of the $350 billion to invest it directly in banks. And he's invested it directly as preferred stock in banks, which provides additional liquidity and stability. These are essentially almost mirror images of the same investments that Warren Buffett made in Goldman Sachs and GE. He put, I think, about $10 billion into each company as a form of a preferred stock, which counts as what's called Tier 1 capital and allows to stabilize the banks. So Paulson followed suit. His terms are not as tough as Buffett's. He doesn't quite get as high a dividend or as much participation in the upside, but there's still a dividend and participation for the government and an incentive for that money to be paid back. And recently Paulson said that he does not expect any more major bank failures now that the TARP is in place, and he's put money into a wide variety of institutions. The top 9 financial institutions received money, which represent 55% of our banking assets, and then another 44 smaller institutions as well. Now that does not specifically encourage house lending, but the Fed has been doing that through purchasing mortgage-backed securities from the Fannie Mae and Freddie Mac, and that has lowered the cost of borrowing. Another thing we're going to look at here is another aspect of what happened was the rating agencies. And the SEC, the Securities and Exchange Commission, released a report recently on the rating agencies. They got this power under the Credit Rating Agency Reform Act of 2006, but that act simply allowed competition in the rating agency business and didn't really truly regulate them. The SEC in its report said, then looking at Moody's, Standard & Poor's, and Fitch, they said that rating agencies made out-of-model adjustments. They did not document the rationale for those adjustments. None of the rating agencies examined had specific procedures for rating mortgage-backed securities. Rating agencies were not required to insist on due diligence, and they did not obtain reports assessing the level of due diligence by issuers.